So in this video we will be discussing the formulas for computing cost of capital, for cost of equity, cost of preference, cost of debt and cost of retained earning. So with respect to equity, there are two approaches, growth approach and earning approach. The growth approach says KE is equals to D upon P plus G. Here the KE simply means cost of equity, D means dividend per share, P means the market price or issue price of equity share, G means dividends growth rate, equity dividend growth rate, F is the flotation cost. If the flotation cost or the share issue expenses are given, then it should be deducted from the market price or issue price. With respect to earning approach, KE is equals to E upon P. Here KE again it means cost of equity, E means earning per share, P is the market price or issue price and F is the flotation cost. Here E can be calculated, E means EPS can be calculated by dividing present earnings after tax by number of equity shares. And with respect to cost of equity, there is CAPM model, also capital asset pricing model, which says cost of equity is equals to RF plus beta into bracket RM minus RF. Here the KE again cost of equity, RM is the market return, RF is the risk free return and the beta is the systematic risk associated in the business. Then second is cost of preference share capital. Here we are having two approaches, for irredeemable preference share and for redeemable preference share. For irredeemable preference share, it is KP is equals to D upon P, where KP stand for cost of preference, D stand for preference dividend per share, P stand for market price or issue price, F stand for flotation cost. We need to note again here, as in equity, if there is a flotation cost or share issue expenses are given, we will subtract or deduct it from the market price or issue price. With respect to redeemable preference share, KP is equals to D plus 1 upon N into bracket R minus P upon 1 upon 2 into bracket R plus P. Here the KP is the cost of preference, D is the preference dividend per share, P is the market price or issue price, R is the redemption value return price, N is the number of years, F is the flotation cost, share issue expenses. So the cost of debenture, third concept. Here again there are two approach, irredeemable and redeemable. For irredeemable debentures, KD is equals to I upon P into bracket 1 minus T. We are giving the effect of tax, where KD is equals to cost of debenture, I is equals to interest on debenture, P equals to market price or issue price of debenture, F is flotation cost and T is the tax rate. For redeemable debentures, KD is equals to I plus 1 upon N into bracket R minus P upon 1 upon 2 R plus P into 1 minus T. We are giving again tax effect. After tax we are calculating cost of debenture, where KP is equals to cost of preference, I is equals to interest on debenture, P equals to market price or issue price, R equals to redemption value, N is equals to number of years and F is equals to flotation cost and T is the rate of tax rate. At the last we are going to discuss the cost of retained earning, that is cost of profit that we are reinvesting into the business. So these cost of retained earning is the cost that we have foregone by the shareholders. It is equals to the income that the shareholder could have otherwise earned by placing these funds into alternative investment, as we have reinvested this into the business. If we will not invest, we will distribute to the shareholder and shareholder will invest in some alternative investment. So what will be the KR, that is cost of retained earning, is equals to KE into bracket 1 minus T into bracket 1 minus B, where KR is cost of retained earning, T is tax rate, B is the brokerage rate. Many authors also claim that cost of retained earning is equals to KE only. So whatever cost of equity, that will be the cost of retained earning. This is the opportunity cost, this is the implicit cost and all the other three costs are explicit cost.